Welcome to another presentation of Capital Economics. The title of today's presentation is Oil and Gas Boom or Bust, which incidentally is also the title of one of our chapters in our book, The Cynic's Guide to Investing in the Era of Too Big to Fail It Pays to Be a Cynic. Check out that book. Before we get started, I would like to ask the audience to take a quick second to please like, share, subscribe, whether you're on our website at thecapitalnews.com or on our YouTube channel, wherever you may be listening. It takes a quick second, and it does help us out tremendously, and we truly appreciate it. So thank you for doing so. Again, title of today's presentation, Oil and Gas Boom or Bust. This is a continuation of our conversation that we have been having on various podcasts at the Capital News, and today I just wanted to take a brief few moments to actually allow the audience to see visually what we're looking at when we're talking about the price of oil, the price of natural gas, and then with some of the news that has been surrounding the headlines over the past couple of weeks, and will probably continue to make some of the headlines over the coming weeks, has to deal with OPEC and OPEC Plus and their recent announcement to cut nearly 10 million barrels of oil production per day. And of course, if there are non-OPEC countries that join this movement, if you will, it could double that to nearly 20 million barrels of oil per day being cut from production. But let's take a quick look here at crude oil prices, and what we're going to look at is West Texas Intermediate, more commonly known as WTI. This data is sourced from the U.S. Energy Information Administration and the Federal Reserve Economic Data, or FRED, Federal Reserve Economic Data. So a little bit of history, a little bit of historical perspective, which we like to do here at the Capital News. We look back, data going back to 1986. And for the sake of argument, you're going to say, well, for the course of about a decade, a little bit over a decade, you have prices trending around $20 per barrel. Not too bad, relatively stable. A couple spikes up, a couple drops low, but nothing out of the ordinary, nothing too drastic, right? Then you get a nice run up during the dot-com era because everybody thinks that everything's going off to the moon, everything's boomtown, and then of course you have the dot-com bust and crash, and the NASDAQ going down almost 70-80% when all is said and done. And of course, oil comes back, basically reversion to the mean and getting back to about that $20 a barrel level. Then following the recovery, the subsequent recovery from the dot-com bust, you then start entering the era of subprime, and we all know what took place there. Everybody thought the global economy was running on all cylinders. Everybody thought everything was finally fantastic. Recessions were outlawed. They weren't going to happen again. Everybody's spending money like it was going out of style. And then, boom, huge collapse. But before you got that collapse, you had WTI north of $140 a barrel. As short-lived as it was still there. And then you see just the massive, massive drop-off, taking it back below $40 a barrel and trading in the low 30s for quite a while. Then again, rallying, making itself back up to 100 because everybody got used to $100 a barrel oil. The traders loved it. Obviously, the energy companies loved it. They were making a boatload of money, and it got back up there. You had WTI trading range-bound between 100 and, let's just call it $80 a barrel for the sake of argument for a few years. Then the United States runs into a mini recession, a mini manufacturing recession. A lot of the hard-hit areas were in the energy space, oil, gas, shale markets, and you see this huge drop-off. Again, a little bit of recovery. Nothing goes straight down forever. Nothing goes straight up forever. So you see a rebound in the markets, which was to be anticipated and expected, so no surprise there. You get the election of Donald J. Trump. You get tax cuts. You get regulatory cuts. Whole host of things taking place. Short-term stimulus. And you get a rebound in the price, taking you north of $60 a barrel. However, that was to be short-lived as well. Crashes back down, consolidates, range-bound for quite a while. Then you hit COVID-19 and you see the waterfall effect. Again, nothing goes straight down, nothing goes straight up. But in the course of this consolidation here, before the real onset of COVID-19 really striking the global economy, you saw a lot of headline news that moved the oil markets. But you have to understand, and we highlight this almost on a daily basis at our Capital News podcast, the global economy was going south. It was in a downward trajectory well before the onset of COVID-19. So when you understand the principles and the laws of supply and demand, you understand pretty well where oil prices were likely headed. And that was to the downside. So this type of movement that we have been witnessing has been no surprise to us here at the Capital News or at the Capital Economics as well. But these headlines, back and forth, you have to recall last year, what did we see a lot of? A lot of headline news. Japanese oil tanker was struck. U.S.-Iran, a lot of saber rattling. Shooting down drones, shooting down another drone. Taking another oil tanker or gas tanker hostage. The Iranians attacking a Saudi oil field. The U.S. striking Iran, attacking and striking Iraqi bases that house U.S. troops. The retaliation back and forth, back and forth. And you saw these big spikes, but they were short-lived. And the reason they were short-lived is because of the dynamics of supply and demand. The global economy is awash. It is awash in oil and gas. There are storage facilities that are near max capacity. There are oil tankers sitting out at sea with nowhere to be, nowhere to go, because there is not enough demand for the product. Just simply is not enough. Now, we're going to look at the same graph, but with a shorter time horizon, just so you can get a better sense of the waterfall effect. And despite the fact that we have OPEC Plus agreeing to cut nearly 10 million barrels of oil per day, you get your spike off of this waterfall effect. Again, nothing goes straight down, nothing goes straight up, so you expect some sort of dead cat bounce, if nothing else. We got that. You have the headline news. Markets are expecting and anticipating OPEC Plus to cut production. So traders think, okay, well, there's going to be a price spike. There was. And this data is actually 1 day behind, because if we were actually talking about today, April 14th, prices lost another 6-7% for WTI and for Brent, which is the international metric, but it's basically the same movement. But if you're looking at Brent, it's now resting just above, slightly above $20 a barrel. So we're actually back down here, okay? But this is just a shorter time frame to give you a better picture as to what has transpired. Again, you're going back to these levels, 2016, again, coming out of the mini recession, okay, that was primarily contained to manufacturing and the energy patch, if you will. All right, so that's WTI. We also like to talk about natural gas, and these are the Henry Hub natural gas spot prices. Okay, again, sourcing from the U.S. Energy Information Administration, or the EIA, and also the Federal Reserve Economic Data. So here we are looking at dollars per million BTUs, which is British thermal units. And again, going back to 1997 for a little bit of historical context. Look at where we are today. These prices happen to be monthly. It really makes no difference. Understanding the trend, understanding what's taking place from the fundamental perspective of supply and demand is what we're really focusing on here. And of course, we're going to talk at the end of this presentation a little about the geopolitics of everything, because there's a lot of interconnectedness between this and global protests, but we'll get to that here shortly. From a monthly standpoint, this data point here leaves us at about $1.80 per million British thermal units. All right, we haven't been this low again since the mini recession. And then if you really want to look back monthly, you got to go all the way back to where this data set begins. All right, so at these prices, you have to ask yourself, how are energy companies, especially the marginal producers, especially the smaller mid-cap companies, how are they able to sustain themselves on these prices for oil and for natural gas? And the simple answer is they cannot. They cannot. That's why you have the President of the United States trying to have it both ways. Yes, we have to have lower oil prices or lower energy prices because it's a huge tax cut. It's the best tax cut possible to the consumer. Of course, the consumer is quarantined, can't go anywhere. But now the oil prices are so low, now, oh, it's too bad, so sad for the oil players and producers. So we got to get those oil prices back up. So you have OPEC Plus cutting 10 million barrels per day. President Donald Trump tweets out thanking the Crown Prince of Saudi Arabia, thanks the President of Russia, Vladimir Putin. But it's not enough, folks. It's not enough. You got that short-lived spike that we just highlighted in the previous slide. Then it comes crashing back down because of the underlying supply and demand construct. We believe that the only way that oil prices and natural gas, for that matter, the only way that you will have a sustained higher price is if we go to war, and God forbid that happens. The global economy, again, was slowing down prior to the onset of COVID-19. It is going to continue to slow down after COVID-19. Okay? And with it, the same picture, the same trajectory for oil and gas prices, barring some sort of major geopolitical event, particularly war, because it's going to have to be something that's sustainable, because we've seen those geopolitical events come across the headlines, and those price spikes have been short-lived. Okay? Same thing is taking place here with respect to natural gas prices. Again, same thing, but on a shorter time horizon. So again, you can sort of see that sell-off well south of $2 per million British thermal units, BTUs. This trajectory is likely to continue. But hey, if they cut by another 10 million barrels, you never know what kind of price spike you will see. A lot of companies are looking for bailouts. A lot of companies are looking, they're in discussions with a lot of law firms and consulting firms to see how they might go about filing for bankruptcy, how they can possibly restructure. This is the ebb and flow of the market. This is what is supposed to take place. The bailouts are not supposed to take place, but the restructurings, the bankruptcies, what have you, that is what's supposed to take place. Okay? That's just free market capitalism. I know we really don't have it here in this country, unfortunately, but that's the way markets are supposed to operate. Now, to a little bit more of the geopolitical sense of things, I want you to look at this list. These are the OPEC nations, as per OPEC.org. 13 countries: Algeria, Angola, Congo, Equatorial Guinea, Gabon, Iran, Iraq, Kuwait, Libya, Nigeria, Saudi Arabia, United Arab Emirates, and lastly, but not leastly, Venezuela. Okay, now, if you take a look at this list, what also do you see? There's a lot of overlap with a lot of these countries who are a part of the global protests, if you will, that we were witnessing so frequently prior to the onset of COVID-19. Now, they're on a little bit of a quote-unquote halt, okay? Time out, if you will, because of COVID-19. Can't go outside. Can't go outside, can't protest, okay? Unfortunately, so many of these people and so many of these countries and others that aren't on this list, they were at the end of their rope to begin with, prior to COVID-19. What do you think is going to happen after COVID-19, when they're allowed to go back out onto the streets? When prices of their primary commodity, which is the mother's milk for government revenue, is drying up because prices continue to go south and south and south. Algeria was on that list. Iran was on that list. Iraq was on that list. Libya was on that list. They remain in war, civil war. Venezuela, a lot of saber rattling between Venezuela and the United States. You have gasoline lines in Venezuela, despite the fact that Venezuela has the world's largest reserves for oil. They are a net importer when it comes to refined products such as gasoline, and there are shortages. So a lot of these countries are going to break down. They were breaking down before COVID-19. They were breaking down before prices were at $20 a barrel. Less than $20 a barrel, okay? You're talking north of 20, north of 30, and these countries were breaking down. These prices stay at $20 a barrel, $30 a barrel, or lower. And of course, you have to understand the spectrum. You have to understand it's not just WTI. It's not just Brent. There are different grades that span the spectrum. These products will fetch a different price, and a lot of them are lower than $20 or $30 a barrel. So you have to understand the market to understand what's taking place. And you have to understand this is not just economics. This is geopolitics at the same time. And you have to understand, like we have been saying on our podcast for months, that these protests, they are not transitory. They are history in the making. So I hope this short presentation here raises some questions, connects some of the dots, provides a visual for you to understand what has been taking place in the oil and gas markets from a price perspective, and then to also understand the geopolitical risks that are all around us and that are likely to continue whenever this COVID-19, all of these economic, social bans and quarantines are lifted and people are allowed to go back out onto the streets. What's likely to take place? So pay very close attention. Very, very close attention. Now, chances are we're going to continue doing many more of these presentations because we find them to be important. I think it's helpful to the audience not just to discuss these things on the podcast, which we do on a daily basis, but to also provide a visual media for them so you have a better understanding of what's taking place in regards to a lot of these assets and commodities that we talk about. So we'll continue to do so. And since we talk about our book, The Cynic's Guide to Investing, all the time, we'll probably update that because that book was published in 2015 and we did a lot of research, had a lot of data in the energy space for that. So we might update that and provide additional podcasts and additional videos and capital economics presentations as well. So I wanted to add this picture into the presentation simply because I thought, it's interesting perspective. Is that a sunset or is the sun rising? So it goes right to our question, oil and gas, boom or bust. Is this just the beginning or is this the end? Time will tell. Thank you so much for joining us at the Capital News and Capital Economics. Please like, share, and subscribe. Check us out on our website, thecapitalnews.com, our YouTube or Apple Podcasts at The Capital News as well, or follow us on Twitter at the following handle. Again, our book, The Cynic's Guide to Investing in the Era of Too Big to Fail, It Pays to Be a Cynic, published in 2015. You want to understand economics, finance, investing, geopolitics, how it's all connected, how you can build a lasting portfolio. Add this book to your library. You will not regret it. So again, thank you so much. Check us out at the Capital News. Stay diversified, stay vigilant, and stay with the Capital News. I am Alex Karitis. Godspeed.